what did you make of the earnings that came out, and how difficult would it be to pencil in what could happen in Q2, Q3? Because commentaries may not have as much meaning as government actions would have in a large part of your coverage universe, I reckon.
Yeah, hi. Thanks, Neeraj. So, if you split the sector into, at least on the oil and gas side, into say 2 or 3 different subsectors, on the OMCs, as Surendra mentioned, there were significant losses. However, we had actually penciled these in, so we did know how bad marketing was because petrol and diesel prices have not been revised. So, I would say the loss numbers were actually not as bad as we feared, at least in a couple of cases. In HPCL, yes, the loss number was higher than expected, primarily because that's the company which is more exposed to fuel marketing, which is where we've seen all the pressure. If you switch over to the gas side, things were actually much better. So, for instance, the city gas companies all reported decent margin numbers. Most of them reported margin beats. In fact, in a couple of them, even the volumes were ahead of estimates, primarily because CNG conversions are still remaining fairly strong. GAIL also on the gas side reported strong numbers. Again, they are beneficiaries of what's going on globally on the LNG side and the gas crisis. And lastly, if you look at Reliance broadly inline numbers, the O2C segment was broadly in line, maybe a shade below estimates. It was offset by good performance in geo and oil and gas. So I would say that more or less the numbers were in line. OMCs maybe slightly, the loss is not as bad as feared. The city gas company is fairly decent. But on the OMCs, coming to the second part of your question, yes, there's significant uncertainty on near-term earnings. It's if you look at the variables right now, it obviously depends on what's happening in oil prices, not just oil prices, but also the product cracks on petrol and diesel, because this is what ultimately drives the under recoveries for these companies. Now, what we've seen in the last month or so is oil prices have cooled off. Product cracks have also cooled off. So actually lower refining margins, ironically, are positive for the OMCs. Within them, something like an HPCL at the margin would benefit more. But we are still potentially looking at still losses on the marketing side. So say from a 20 rupee loss per litre, it has maybe narrowed to 10 rupee loss per litre on diesel, but it's still there. It's still material. So what will probably be something that the market will look forward to is either signs of more cooling off externally. Say oil prices come off further or the cracks come off further, or some sort of direct or indirect relief from the government, either some kind of compensation as the government used to do in the past, or duty cuts, or maybe even resumption of price hikes, which is a little controversial though given the high inflationary environment. On the gas side, we are relatively more positive. There have been some positive developments on the policy side, which has driven a favorable view for the city gas names. Yeah, so that's broadly how I would sum it up.
Okay, just a word on CGDs, because I think the results print notwithstanding alone, the action taken on August 10th, I presume, or August 9th, as the case may be, and your notes seem to suggest that the outlook then at least was favorable before a bit of a run-up that we've seen already. What's your sense on what does this do to the predictability of earnings print for the next 3 quarters, if at all, and the outlook on the prospects of these names?
Yeah, so it is a fairly significant development in our view. So the government has essentially increased the domestic gas allocation for the city gas companies. Now, if you take a step back, the main pressure that these companies have been facing over the last year or so is rising gas costs. So essentially, the gas crisis, which we are seeing globally, especially in Europe, is gradually, with a bit of a lag, also impacting these companies because domestic gas prices have been moving higher, which is a cost for these companies. On top of that, the domestic allocation, which this is the gas which is slightly lower priced compared to, say, LNG, that allocation also had come down over the last couple of years. Now, the government has revised that policy. They appear to be focused on maintaining a priority for the city gas sector. So they have increased the allocation of this sort of cheaper domestic gas, which is significant from a margin perspective. This was also something which a couple of months back, I think no one was really talking about. People had kind of assumed that, the sector might be a little dead. So to that extent, it's a bit of a positive surprise as well. Now we do have one more event coming up over the next couple of months. So this domestic gas price actually gets revised every 6 months, and on 1st October is the next revision. So net, what could potentially happen is the saving that they are seeing right now for this from this higher domestic gas allocation potentially can be offset by this higher gas price, which we see in October. So there is a little bit of still uncertainty. I think it really depends on, again, government action. I think that's something which we will be quite keenly watching. If there is any relief on the pricing front, that can be another big driver. But net, I think this has been a very significant policy development. It was, not entirely expected, because just 4 months back, the government had actually adversely changed the policy. So in a way, there's a bit of course correction. It appears that the government has identified, the sector as a priority area, and which is why CNG looks like something which is here to stay. So we are pretty positive on the stocks. IGL and MGL, which are the two CNG-focused city gas names, are our preferred picks in the gas sector right now.